Hey guys, welcome back to Dawn Investments. Today we're just going to make a brief video explaining moving averages and how you can use them for your intraday trading. The first thing I want to go over is I just want to explain to you guys the difference between the exponential moving average and the simple moving average, which are the two main moving averages that you will be dealing with as a trader. In this chart, I'm gonna just quickly show you guys the difference. First, as like a definition for these moving averages, traders who use simple moving averages use them in more long-term investments because simple moving averages, the SMA, places equal weight on all data, new and old, and it moves that way according to the price. So for long-term investments, simple moving average would be good because it takes into account old data on top of the most recent data. But for day traders and people who swing trade, just short-term investments, people look more into the EMA, the exponential moving average, because it places more weight on recent data. And when I say that, it affects it because when you place more weight on the recent data, it reacts better to sudden price movements or changes in price that the simple moving average may not flow with. Now, as we dive deeper into EMAs and SMAs, you'll see how important that is for a day trader. That reactiveness, that ability to react to price movement. I already pulled up an SMA and an EMA just to show you that price difference. Not the price difference, just to show you like how different they actually are in terms of reacting to price movement. This yellow line right here is the SMA, and this blue line right here is the EMA. As you guys can see, the SMA is all the way up here because it's averaging both the recent data and old data and moving according to that. Whereas the EMA is lower, as you can see, and is moving with the price because it's averaging and reacting to the most recent data of the chart of this particular ticker, which is DGAS. I'm just using that as an example. So to start off, I'm going to show you guys, how to set it up on Thinkorswim. So I'm going to mainly focus on the EMAs in this video just because we're going over tips for day trading and swing trading and not so much long-term investments. So that's the one I'm just really going to focus on. And that's the one you guys should focus on if you're planning on using these exponential moving averages to day trade. To get these studies on or these indicators on your charts, all you would have to do is go to edit studies like I did. Let me just do it again for you. Edit studies right there. And, type in exponential and it should pop up. You would need, I would say, at least 4 to 5. I use 4 because I use a lot of other indicators and I don't need 5. But if these are your main ones, then you would use 5, and I'll explain why I say that in a minute. First, I would say you need 4 because you're going to have 4 different types of lines. This number 9 is going to change on the other lines, on the other moving averages. You would want a 9-day moving average, a 20-day moving average, a 50-day moving average, and a 200-day moving average. And if these are your main indicators and you don't trade with much other ones, you can also add a 100-day moving average. I don't use the 100-day because, like I said, I trade with a lot of other indicators, and then these just get a little cluttered. And I'll show you guys an example of why I don't use the 100-day one after we go over this. So it simply changes, actually very easy. You can just double tap it here, or click the settings, and then come up here and simply change this to something you would like, and then change the colors. So since we have the 9-day, I'm going to change this to the 20-day, and make it this pinkish purple, and make this one for the 50-day. Make it a different color. You can make it whatever you want, and then make that another different color. Once you have those on, they'll come up on your chart like this. Try to make it color that you remember, or else you might forget which moving average is on there or is bouncing off of. But once you have these moving averages set up, you can now use these as support and resistances. These are, people usually trade off of these, and these are actually good places to go when you don't have a trend line drawn, because price usually bounces off these. As you can see here, like for example, this is the 200-day EMA, and jumping in above this 200-day EMA will probably be a good entry point, because this is where acts as a natural resistance. So if it breaks above this, that would be a good entry point for the stock overall. But coming down, you can see that the stock kind of bounces off. I could probably find a better example than this, but in a way, you see how the stock bounces off this EMA as a support, not a support, I'm sorry, a resistance. And it's basically using these EMA lines as a resistance, and it can't break it. That's why, so once it does break it, usually it will mean that the stock is on an uptrend. But I'm going to look for a better example. But quickly looking at another aspect of the EMAs that you can take into account is when two EMAs cross each other, cross over like this X. When it crosses over and is going downwards, it usually means the price is on a downtrend, and you should pay attention to that signal, as it can really mean something is going down. So I'm just going to look for a better example of how you can use these in practice. Okay, yeah, see, so I'm simply just choosing random stocks just to prove to you how effective they are, no matter what type of stock you're looking at. Even if you don't have any trend lines drawn, they can be used pretty effectively. So as you can see with this stock right here, HMNY, it's bouncing off an EMA like this. And you can tell that it's using that as a support. And since this EMA is trending upwards and it's bouncing off this EMA, it probably would have been a good time, if you caught it right here, you notice it right here, that it would have been a good time to jump in, simply because it was bouncing off of it. And then here you can see the EMAs crossed over on a downtrend, and then the price also started moving downwards. So pay attention to that sign, and also bouncing off of it like so. Maybe looking at another example, we can look at, yeah, just the same general idea. As you guys can see, like, the EMAs are generally used as support and resistances. Traders look at these as buy points. So as you can see, this bounce goes up and then bounces off an EMA, and then like an EMA, once it's at the EMA line, it'll be a good place to buy the stock, because from there, most times, if it has other significant factors, good buyers, and volume, it'll bounce off the EMA and go up. As you can see here, it doesn't do it exactly on it, but it bounced off this EMA, went up, bounced off this EMA, went up, bouncing off this EMA, and it's probably going to go up again. And that's usually how you can use these intraday, and which is why EMAs are better than the simple moving averages, where the lines probably might not be as close or as reactive to these price changes. Just looking at one more, I'll look at this one for today. Let's just show you guys a crossover on an uptrend, I showed you guys crossovers, how they can cross over for a downtrend. I'll show you how crossover for an uptrend. For this stock today, in the beginning, you see the two EMAs crossed over and it went down. But then here you can see two EMAs crossed over on an uptrend and the price went up. So these are just signals that you can use to jump into stocks. Like once you see the price going up and then the EMAs cross over and it bouncing off an EMA, this would be a great price point to enter the trade at. As you can see, if you would have entered here, you would have made good profit. And then it goes up and then it comes down and uses the EMA as a support again, and then it bounces up. And now it's using the EMA as a support again. So just showing you guys that, I hope you guys understand how effective the EMAs can actually be. And going back to my point earlier why I don't use 5 EMAs, I only use 4 is because of this reason here. As you can see, I have a lot of other indicators that we can get into at other videos, but when I have, with these multiple indicators that I have, having 5 would just make it even more cluttered than it already is. That's why I choose to use 4. But if you don't use any of these other indicators, adding the 100-day EMA would be beneficial in trading. But overall, that's really like the basic idea behind exponential moving averages. And I can get more in depth. You could just let me know, or I'll make more videos in the future on it, just going more in depth on how these EMAs can affect trading and things of that nature. So I hope you guys enjoyed the video. Stay tuned for more. More is definitely coming. Thanks for watching.